Sorry about that. I've been talking with the mic off. Let me start over again. Yesterday we gapped up, pulled back 50%, sold off and tested that low. The bulls see this as a double bottom bull flag. This is the neckline, and they want a measured move up. We're at a price level where yesterday we sold off 3 times, and the bears would like to do that again. Today is an FOMC announcement day at 11 o'clock, and 50% of the time, the initial move on the report reverses, and there's usually a reversal in the first 10 minutes. And as a result, I usually do not take a trade in the first 10 minutes. Maybe once a year I do. I usually wait until at least the second bar closes to get rid of that initial reversal. You get a lot of bear bars here, one, and then down, down, and the bears are trying to go down again. Yesterday was a trading range day. We gapped up, we went down, we went up, we went down, and now we're right in the middle of it. That lowers the probability for stop entry traders selling below 1. Monthly chart, extremely strong rally, but a parabolic wedge, 3 legs and a tight channel, 1, pullback 2, pullback 3. A rally that looks like this usually will not become a bear trend without first going sideways for a lot of bars. And the bulls have been so eager to buy this year that no bar has traded below the low of the prior bar since November. And therefore, if the bulls get a chance to buy below last month's low, they'll take it. Chances are when we do reverse, the first reversal will simply be a few months down, and it'll be a bull flag, and we'll test back up. Weekly chart, I've never seen the E-mini this overbought, at least by one measure. The number of bars far above the weekly moving average. It never really got all that close, even here, and that's very unusual. Daily chart, this rally looks like this and looks like this. These two were followed by pullbacks. This one probably will lead to a pullback as well. But I think we'll probably test down here, which are the targets on the weekly and monthly charts. Weekly chart, we have a triangle. The prior higher lows are targets. I think we'll get below the first one, which means we'll get down here at some point. It took several months to get here. It probably will take several months to get back down there. All right, similar to yesterday, a bear reversal bar at the same price level. Today the body is smaller and the tail is bigger, and we're in the middle of yesterday's trading range. Yesterday we gapped up, we sold off, we rallied, we sold off. And we're in breakout mode. We have a double bottom bull flag, bull trend, double bottom, and this is the neckline. And the bulls want to break above the neckline, measured move up. The bears want to break below the double bottom and a measured move down. Probably limit order trading, not a very good looking sell signal bar. What's the chance it's the high of the day? Maybe 20 to 25% chance. This is probably a limit order open. Probably more buyers at the one low and at the moving average at yesterday's close than sellers. When there's an FOMC day like today, the market usually trades normally for the first 3 hours or so, and then sometime after 9 or after 10, it typically goes sideways. Bulls, you can see they bought the one low. They're hoping that this is simply a pullback from the breakout above this bear channel, bull flag, and that we continue higher. The odds obviously favor the bulls. Yesterday is a sell signal bar on the daily chart. We have a parabolic wedge and a bear bar closing on its low. That means the bears want to get below yesterday's low. For the bulls, opening reversal. Now, when you look back at one, you think, maybe it really does not have a lot of chance of being the high of the day. If 2 is a decent bull bar, opening reversal up from the moving average. Yesterday we had 2 legs down to the moving average, and that became the low of the day. Here, let's say we have a good looking bull bar, 2 to 3 tick body closing on its high, then probably 25% chance it's the low of the day. For the bears, I would not take the swing short below 1. For the bulls, it's a better setup, but we have a lot of bear bars on that screen, and most traders will not buy above 1 unless it's pretty much perfect. And it looks like the market is going to wait until the final seconds to let us know. If it only has a 1 tick bull body, for example, you're being forced to buy high up in yesterday's range above a weak buy signal bar. 2 tick bull body closing on its high, the bulls would have a better chance. Okay, so that's exactly what I'm talking about. A 1 tick bull body, is that enough to reverse 1, especially given the way the market has behaved over the past 81 bars. You're being asked to buy at the top of a tight trading range above a bull bar that only has a 1 tick body and after a bear bar. So first bar, maybe 20% chance it's the high of the day. Second bar, maybe 25% chance it's the low of the day. So probably better to wait to sell a micro double top or buy a high 2 or a micro double bottom. Bulls who bought the 1 low have not yet made money. It had to go up 5 ticks. By the way, on that close of 1, because it was in the lower half of the bar and there was room to the moving average, you had a lot of traders who just sell the market. And you can see the open of 2 is at the close of 1, telling you that there were a lot of traders who sold. It had to fall 5 more ticks for those bears to make money, and it did. And you can see it reversed up at the moving average. And it's an obvious buy signal bar, and yet 2 minutes into bar 3, we cannot get above the bar 2 buy signal bar high. So this is warning us that this is probably not going to be a early trend on the open, and that we'll probably have another trading range open. Bears trying to prevent the buy above 2 from triggering, because they know a lot of bears will get out above a bull bar, bar 2. Bulls, micro double bottom, but bear bar 2. No one has made money today so far except the sell the close bears on bar 1. And we're within yesterday's trading range. So the market's deciding, do we break above yesterday's range and rally for a measured move up, or do we break below yesterday's range and sell off for a measured move down? Most days over the past month have had early trading ranges. And if you were only looking at the past month, you would assume that all days have trading range opens, and that's not the case. The market goes through phases when it tends to do a lot of the same thing for a long time. And if you look at the daily chart, a lot of trading range price action here, here, here. And when you have a lot of trading range price action, the days tend to have a lot of trading range price action, a lot of prominent tails, a lot of reversals, and 5-minute charts tend also to have a lot of trading range price action. And a common thing when the market is in a trading range is to have a trading range open. I just looked at Boeing Airlines, which is, I think, the strongest trend on the chart in the market. Percentage-wise, it's not the biggest percentage gain of any stock, but it's really, really impressive for a major company like this. Here we had a very tight bull channel, a buy climax. We got a pause, and then we have a buy climax here. And I'm assuming earnings came out, and this is what we're getting, up 7% after already extremely strongly up. Weekly chart accelerating up, very climactic, but no sign of a top. Monthly chart. Hugely up, really unusual. We get pullbacks after very strong rallies, and this is incredibly strongly up. I don't know what to make of it. It obviously can go up a lot further, but that is so climactic late in a bull trend on the monthly chart that I don't know who's buying up here. Everyone wants to buy back to the daily chart, but I don't want to be buying a market that is that strongly up. You can buy for a trade, looking to hold for a day or two or three, but if you're wanting to invest in Boeing, holding for a year or two or three, I think it's better to wait for a pullback. All right, so opening reversal up from the moving average, but bar 1 only a 1 tick bull body, and bar 2 1 tick bull body, and bar 3 a bear body. So still only 25% chance this is the low of the day. I think we're always in long. Yesterday, even though we sold off for more than half the day, I thought it never was particularly bearish. And now we have a double bottom bull flag, rally, gap up, and then double bottom, and we're breaking above the bear channel. What do? Now we have a small double top just below yesterday's high. Yesterday has a small range, and it therefore has an increased chance of leading to a measured move up or down today. The bulls want the break above yesterday's high and a measured move up, and the bears want the break below yesterday's low and a measured move down, especially since on the daily chart, yesterday's a bear bar and it's a parabolic wedge, and therefore it's a sell signal bar. What do you do here? We have a second failed breakout above the bear channel. We have a bear channel, a breakout, it failed. The bulls tried to resume up again, and now they're failing a second time. I think this is very, very difficult to make money here. Here we have an opening reversal up from the moving average, and the market has only rallied 4 ticks in 10 minutes. So very quiet open. So I think better to wait for the momentum up or down to increase. Globex market, a bear channel, a breakout, and a pullback, and the bears hope it's a reversal, big up, big down, and sideways, and then possibly down. Globex market, big up, big down, big confusion usually means sideways, and 5-minute day session, multiple reversals in a trading range. buyers or sellers below 5. I think we're always in long. Obviously, this is not particularly bullish, but because I think it's always in long, I think it's more likely buyers below 5. But given that the momentum up so far today is so small, it's probably better to wait. A second entry for the failed breakout attempt above yesterday's high, but it's higher, it's more reliable if the second high is above the first. This is not. And it's more reliable if both are above yesterday's high. So this is not a high probability sell. For the bulls, 4 is a breakout of a bull flag, a pullback to the moving average. I think we're always in long, but not strongly bullish. The bears want a lower high. I think it's a limit order market, and the range is so small, it's even difficult for limit order traders to make money. So better to wait. Top of a tight trading range. 15-minute chart. Looks like a double bottom bull flag. We have a wedge bull flag here. 1, 2, 3. A bull breakout and a pullback to a double bottom. And bulls are trying to get a breakout above the neckline. Double bottom neckline. Maybe one more push up. 1 or 1, and then 2, and then 3. Bears want it to stay sideways, because if it's sideways, they can create a major trend reversal. $60-minute chart. Bull trend, bull flag, small bull flag, trying to break out. Suppose we get a third sell signal bar, 1, 5, and let's say 9. It doesn't matter. The market is in a very tight range, and stop orders. Well, nothing is profitable when the range is this tight, but you're selling below 1, selling below 5, buying above 2, buying above 6, buying above 8. Unlikely to make any money. Tight trading range, but above the moving average and in a bull trend, so slightly more bullish than bearish. I think best choice is flat and simply wait. What about buying on a stop above yesterday's high? Since it's a sell signal bar, if it gets a bull breakout above a sell signal bar, don't you have a lot of trapped bears who front ran the sell signal? Well, I would. This is not a good environment for buying with stops on a breakout, even though we're slightly more bullish than bearish. The market reversed down here 4 times, yet is not selling off. So the bears who've been selling at this price level probably will give up if we start going 2, 3, 4 ticks above the tops of these bear bars. So we might get a breakout bar here. I gotta shrink the bars because it's too difficult to see what's going on. 60-minute bar, getting near the end of the first hour. $60-minute day session. 60-minute Globex, looks like a pullback and a bull flag, a bull IOI. So you do if you're long. I think you probably get out of longs below 11 if it closes on or near its low. A double top 1 and then a wedge with 2, 4, and 10. So I would get out of longs here, even though we're still always in long. And as for bears selling, you get a double top. I would wait. But anyway, for the bears, it's a double top with 1 testing yesterday's high. A lot of times when you have a day that's within yesterday's range, it goes up and tests yesterday's high, and then reverses down, or initially goes down and tests yesterday's low and reverses up. So a lot of times you'll get a reversal just below yesterday's high or just above yesterday's low, and then it tries to test the opposite extreme. Sometimes, so you can get an inside day. Sometimes the breakout will go a little bit above the high, yesterday's high, and then below yesterday's low for an outside day. What do the bears need to see to make this short? Well, simply the size of this bar, plus stop entry bears made money. Simply the size of the bar is enough, I think, to make bulls not buy. Right before a bar closes, it often does something that changes the appearance of the bar. The 60-minute bar closes in a few minutes, and it was a big doji bar with a possible bull body, and now it's a bear bar just because of this one bar on the 5-minute chart. Looks like a give-up bar. 60-minute bar probably will close near its low. Here we have a trading range, and we have a double top lower high. You can call it a triple top, but I think of it first top, and then the second top has a double top. You can call it a triangle, whatever. But for the bears, it's a double top lower high major trend reversal. Not yet, always in short, but the size of this bar makes me think the odds are we're going to trade down. Anyone going to buy this close? I would not. See, it's important. The close of this is important, right? Having that bigger tail, I think, erased a lot of the bearishness. So the bears, I think, need one more bar to make it always in short, but they certainly made it a lot less bullish. Can you simply sell here and put a stop above 11 and take a chance that this, in fact, will be the high of the day? The problem is the math. The probabilities are just not very good. That tail on the bottom of 12, and then the 6 ticks reversal up from the 12 low erases most of the bearishness of 12. For the bulls, we have a bull flag, a breakout, and a pullback to a double bottom. A smaller version of of this, a breakout, a pullback to a double bottom rally. We have a breakout, a pullback to the double bottom, and bulls are hoping for a rally. I still am neutral. The market's deciding what to do with the close of 13. Will it have a bull body and weaken the bear breakout, or will it be a bear bar closing on its low, possibly at a new low of the day, which would make it, I think, always in short. A bear inside bar, would it be always in short? Probably, but sometimes you'll get the reversal on the second bar. So instead of on bar 13, sometimes you get the bull bar on 14, and that would erase any bearishness of 13. When it's taking this long to let us know, that means the market does not have any energy, which we already know. For the bulls, a double bottom higher low 12, but 2 bear bars and a bad buy signal bar. And for the bears, we have a double top test of yesterday's high and a reversal down, but a big tail 12 and bad follow through 13. So still, I think, neutral. Swing bears, they can be short and they can sell at the market, stop above 10 or stop above 11, looking for a test down below yesterday's low, but not, it's really hard to make the math work because the probability is not all that high and the reward is not that much bigger than the risk. For the bears, they're hoping that this is a breakout test of the 11 low and the start of a swing down. 12 was a big enough bar, so it looks like a give up bar. Follow through for the bears not all that good. Sometimes when you get a big up bar, a give up bar, the market goes sideways for many bars before you get the swing down. Yesterday we had a small give up bar 33 and it went sideways for 20 bars before we got a reversal down. Buyers or sellers below 14. Well, 12 is a good bar for the bears. The follow through is bad. We're still in that tight trending range. 12 is enough, I think, to discourage a lot of bulls from buying the 12 low. But the follow through 13, 14 above the moving average discourages a lot of bears from a stop entry sell. Limit order bears 13 high made money, which is good for the bears. Stop order bears below 11 made money, good for the bears. But the follow through has been bad. So the math is not very good yet. Might be a triangle. A wedge with 8 and 12, but too many bear bars. So not a very good buy. Similar to the channel down that we had yesterday. Never very strong, but lasted for a lot of bars. I think we're always in short, but I am not very bearish. This is still a pullback testing yesterday's close, and then it's a pullback testing yesterday's low. The bears are not getting enough selling to make traders eager to sell down here. So what do? Not a good buy signal bar 17. But a bad bar for the bears. My general rule, if you're taking a swing trade and you're not sure, is to get out above a bull bar. So if 18 is a decent bull bar, not more than a 3-tick tail, I think a lot of the swing bears will get out above, and some bulls might buy above, taking a chance it's a wedge bull flag. And a big high 2 legs down, 1 pullback 2. But obviously, really difficult to trade the markets, just not moving very far. still probably always in short. It's similar to yesterday's sell-off where we just had a small pullback bear trend that just drifted downward. So do the bears get out above 18? I don't know. I probably would think about getting out a couple ticks above 18. Right now the stop is probably above 15. And for the bulls, it's not strong enough to buy. I think most traders should not be doing anything. They should just be waiting. Well, that's bar 18. So now we start getting into a little bit of math. So right now, 90% chance either 18 is the low of the day or 1 is the high of the day. I should say lower high up until the FOMC report. Today we have a special event at 11 o'clock. And, because of that, you do have bulls who will buy 1 tick above 18, taking a chance that it's the low of the day and that will break above 1 and get a measured move up. And theoretically, bears will sell 1 tick below 18, betting that if we break below the first 18 bars of the day probably will not get back above the high, or at least not back above the high until possibly after the FOMC report. Usually, if I'm trading the breakout, selling below 18 or buying above 1, I'll do it if the momentum is pretty good. And this is trading range momentum, and therefore it has a higher probability of leading to a reversal than a breakout. So I think a reversal is more likely than a breakout. If we fall below 18, I think it's more likely that we reverse up than get the measured move down. Kind of like yesterday, a weak rally, and it broke to a new high after bar 18. And because the rally was weak and we had the early trading range trading, it was more likely to lead to a reversal instead of a measured move up. I'll read back to always in long. I really don't have an opinion. I think it's 50-50 chance that we're always in long and we'll go up to the high, 50-50 chance we'll go down. I think it's slightly more bearish than bullish. We have a double top at yesterday's high and we're reversing down with lower highs and lower lows. But I am currently flat. Extremely quiet. Usually if the range is only 2 or 3 points tall, I don't do anything. Obviously the range here is only about 4 points, not even 4 points, it's 3.75 points, 99% chance the range is going to be bigger, almost 100%, 99.9% chance the range will be bigger because we have that FOMC report at 11 o'clock. However, this is just too tight. Stop order bulls have bought above 19. Here we are 6 bars later and they have not made a point. And for the bears, they see the wedge bear flag, the wedge bull flag, 1, 2, 3, the high 2, 1, 2. And, although always in short, they're not making much money. If I had to be long or short, I'd be short, in part because the best signal bar of the day is bar 11, and the market has a 90% chance of a 4-point swing from a good signal bar, stop entry signal bar. But it would not be doing this if either side had much of an advantage. Bears have 2 legs up, 22, 33, and a lower high and a bear channel. But I think it's still probably better to do nothing unless you're willing to sit through a lot of bars waiting for a 1-point scalp. Bears running it there. Breakout below 18, hoping for a measured move down. But we're in that final hour before the FOMC meeting for the bears. Head and shoulders top, bear flag. Room to yesterday's close, we'll probably get there, which means we'll probably break below 18. Room to the 60-minute moving average. Room to yesterday's low. It looks like we're going down, but selling with a stop. 1 tick below 18, I think it's not worth it. And I did not do anything with the 40 low, so I'm flat. Bears got their breakout. The bulls hope for a wedge. On a small day like this, instead of a 4-point sell-off below 11, a lot of times you just get a 3-point sell-off, which is where we are now, 14 ticks down. It's probably a good time to go through the FOMC charts. I think with an FOMC day, you have to be prepared for anything, and the odds are we're going to get a breakout. In fact, we always get a breakout, but sometimes it's small and does not last long. Prior to a couple of years ago, this was a fairly common occurrence. You'd get a very big breakout and a trend. Again, it reversed, it sold off to the downside strongly. This is big. This is a 10-point sell-off in the first 5 minutes, and then it reversed up, and it's a 20-point tall bar. This is extreme, but it illustrates the point that if you enter on the first bar, it's really hard to make money because 50% of the time, the first bar has a strong breakout in the wrong direction, and then the market reverses. It would be nice if we were to get something like that, but the odds were against it. Here, there was a little bit of a bear breakout and a reversal. What's important with this one is the bar after the breakout bar did not have a bear body. It had the minimum necessary for the bulls. It had a doji body. There's one other very important point about this slide. If you bought above the high of this inside bar, your stop is down here, so you're risking about 6 points or so. The size of the tail on that bar, if you bought that close, the size of the tail on this doji is almost 5 points. So if you were using a 3 or a 4-point stop, you would have been stopped out. If you take the buy, you have to use the obvious correct stop below the low of the bar. And that's true here as well, and it's worse. Right, so if you buy this close or that close, your stop is all the way down here. And in this case, it's 25 points. A lot of traders, instead of risking all 25 points, they would put a stop order, a little bit below a 50% pullback. So let's say it's a 24-point 2-bar breakout, then 12 points is the halfway point. Maybe they put a stop at 14 points, a little bit below 50%. Another strong breakout and a pullback, couple legs down, 3 legs down, bear, bull, bear, bull, bear, bear. Okay. Wedge top, consecutive buy climaxes, 1, 2, 3, 4. Like any other consecutive buy climax pattern, you always have to be suspicious after the 3rd or 4th push up, because it tends to function like a wedge. So if you see consecutive buy climaxes, especially after a 3rd or 4th push, you have to be thinking about exiting your longs. Here, this breakout is strong enough to start the count over again. So 1, pullback, 2, but 2 is very big. So maybe 2 will be a 1, 2, 3. Not a big breakout, not a big bear breakout, but still a bear breakout. And deep pullback below 50%. 3 consecutive bear bars, but did not fall below the bottom of the bull breakout. And even with the 3 bear bars, bulls would buy either above the bear bar. I tend to buy above the bull bar that followed it. And the bulls were lucky. They got a 15-point rally. Again, these strong trends are less common than what we get now. This is interesting. We had a strong rally and a big reversal, but the bear reversal did not break below the bottom of the bull breakout. It got exactly to the bottom. So theoretically, if you bought a close here or here, your stop is below that bottom of the buy climax or the bottom of the bull leg, and you'd have to risk a lot, but the market behaved the way it should behave if it's going to try to go higher. Strong move down, big reversal up. Okay, big tail, big tail. So yes, consecutive bull bars and probably always in long, but why the big tails on consecutive bars? And that made a lot of the bulls hesitant. You can see we went sideways for about 7 bars, and to short below that doji bar for the double top, I don't know, that's not all that good. You sell below this bar, I don't know, that's not that good either. So when I see a first bar that looks like that, I'm inclined to wait. And then if we get consecutive trading range bars, the market's probably in a limit order market. And stop so far, the moves are fast. And usually in that kind of a situation, I just wait. And I would, after a breakout like this, you'd expect at least a small second leg down. Here we have a high 1, a high 2, a slightly higher low, but only a 1-tick bull body. I probably would wait. If I don't remember how I traded that, but if I were trading it, I probably would have waited to buy above this bull bar. And, it's a wedge and a second or third leg down. It's a small wedge here, a bigger wedge here. So I would have waited for the really good bull bar over here. Nothing else is all that good. I don't want to buy up there. I don't want to sell here. I don't want to buy here. I don't want to sell there. I don't want to sell there. Well, it's sell the close, probably sellers here, which is okay to sell that, or sell below here, a low 1 short, a below here, a low 2 short. But once you get that good reversal, I think the bears get out and the bulls probably would buy. Bear breakout. Look at initially bull breakout and it reversed. Not all that good follow through. Not all that good follow through. A bear body, so always in short. Maybe you sell below here, it closes below the midpoint, and then you have a double top bear flag. And as it's often the case with double top bear flags, the rally is strong enough to make you think there might be buyers below. But double top bear flag holding at the moving average, I think it's an okay swing, and then it became sell the closes, maybe here or here. And the bears got a trend for the rest of the day. Okay, big rally on the report. Okay, big outside up bar closing far above the high of the day, but then terrible follow through. I think a difficult short. It's an IOI with a bear bar, but a big tail here and a big reversal here. Looks like a limit order market. The bulls tried to get a reversal here, but look, this bar did not go above that bar's high. And whenever you see a good looking reversal bar for the bulls like that, and the market cannot get above the high of the bar, you got to think that the reversal bar is not a reversal, it's a pullback. And therefore traders either sell below its low, or if the following bar is the bear bar closing near its low, they'll sell below that. But reversal up, not really easy trading. And traders mostly are scalping. I probably would buy here. You got 1 leg down, 2nd leg, 3rd leg, decent bull bar. I probably would buy here. And I would be concerned by that tail. And I would either get out below that bear bar or below that bear bar. And if I was really quick and smart, I would short maybe that close, that close. This is a tough high to sell. You get a bull bar and a double bottom, but bad follow through after every bear bar, after every bull bar, trading range open. Not a really good looking buy. If I were buying, I'd buy above either this bull bar or this bull bar. And even then, you still get above this minor lower high, but not above that one. And you have 3 strong bull bars and you still reversed. So really, really difficult to trade. When I see a lot of reversals like that, I tend to scalp. And I always look to the left and get an idea of how big the bars are. If the bars are 5 to 10 points tall, I tend to scalp for 2 points. If they're 2 or 3 points tall, I tend to scalp for 1 point. Anyway, this kind of price action, I think, is more typical of what we've been having over the past couple of years. Lots of reversals, lots of trading range price action. Those strong trends that I showed you are much less common. Here, we had a very strong bull breakout and then a huge bear breakout, probably at least a second leg down. And then you have to wonder, why are we getting another bull bar? I probably would buy that, and maybe I'd get out below that bar, and I would buy again here. And if I swung it, I would have had I don't remember how I traded it, but that's a 20-point rally. Again, this kind of a thing is less common nowadays. This is more like what we've been getting, and it makes it very, very hard. Okay, this is November last year. We have a bull breakout. No, we have a bear breakout. No, we have a bull breakout. No, we have a trading range. All right, so really tricky to trade. For me, potential final flag, I would buy above this. I would hold long. I'd probably get out here. It's a second entry short. Failed breakout of this high, a bear bar. Doji's probably a limit order market. I might buy here, and then I would get out there, and I would just let it go. So this would be a day where you do a lot of work and not make any money. Okay, a big bull breakout, a bigger bear breakout, and now a reversal. Maybe you buy here or above that bull bar. And what do you do up here? It's an expanding triangle. It does not look like one, but you got to be thinking, we went up, we went down, we went up, we went down, we went up. A lot of traders would exit once they started to see okay, you got a breakout and a bear bar. Some traders would exit below that. Some would exit below the second one. Most traders would get out below the third, and that's why the third bar is a big bar closing on its low. The final bulls gave up. And can you short? Well, it's always in short. You get 3 or 4 consecutive bear bars, a pretty good reversal. A lot of trading range price action. We may just go sideways here. And so if you sell that close or you sell this close, what do you do here? You got a failed breakout low of the day. I think a lot of the traders would just buy back the shorts above that bull bar. We got a breakout to a new low and then a bull bar closing on its high. That's a reasonable exit. Really aggressive traders might sell the low 2, low 1, low 2. I usually would not do that. Maybe I would, 25 years ago, but, when I was young and had a lot of energy. But now I look for things that are fun. Again, this is more common. This is a year ago, last summer. And this is the kind of thing that we've been having a lot of in recent FOMC reports. Okay, a bull breakout, a bear breakout, not good follow through, still in the tight trading range. Good looking reversal, it's a buy. Disappointing follow through, so traders will be quick to get out. Maybe here, low 1, low 2, wedge 1, 2, 3. If not there, then here or below the bear bar. Sell the close, but you have to bet that it's not going to go down all that far. Also, you only got 6 bars left in the day. But this is the kind of thing that we've been getting lately. So anyway, I just wanted to give an idea of the kinds of things that can happen. The strong trends that we used to get, the relentless trends, stopped a couple of years ago. And now we have a lot more trading range price action. Obviously, if we get a relentless trend, I'm going to, try to swing at least part. But my assumption going in is that we'll get a lot of trading range price action, and I will probably be more inclined to scalp until I see 2 or 3 or 4 consecutive trend bars. We have about a minute to go. I never care as a trader. I never care if they raise rates or lower rates. All I care about is whether or not I can make money. So I just care about the way the market moves after the report. Again, I rarely enter a trade until after the second bar, so the first 10 minutes, because 50% of the moves on the report fail and they reverse. All right, so let's see what happens. In the old days, a lot of times the report would come up 5 or 10 minutes late, and now it usually comes out very close to 11 o'clock. I don't care whether they raised or lowered. All I care about is how the market is reacting. This is 2 legs down, 1 pullback 2, and a 2-day trading range. We're near the bottom of a trading range. So, odds are we're going to try to reverse up. Not a good looking buy above 54 or above 52, but the context is good for the bulls, plus all the higher time frame charts are in bull trends. As for trading smaller time frame charts like 1,000 ticks per bar or a 1-minute chart, I have done that. I haven't done it in years, but when I had when I was a lot hungrier, I used to do that 1 or 2-minute charts. Now I just trade the 5-minute chart. Remember, I said that over the past couple of years, there have been many more trading range reactions to the reports and fewer strong trends. We could still get a strong trend, but so far this is hesitant. And look at the screen. 2-day bulls want the bar to close on its high and above the 54 and 53 highs, and the bears want the opposite. Looks like a trading range type reaction to the report. It's slightly more bullish than bearish. We've sold off for 4.5 hours with a lot of trading range price action. You can see the final seconds the bulls got their close. Probably always in long, but I always prefer to wait for a second bar. 60-minute chart, a trading range and a bull trend, and therefore a bull flag. Just look at the screen, right? A lot of traders are concerned that we're still in the middle of a 2-day trading range. So even though the context is bullish, and even though the first bar is bullish, the bears still can get a bear flag, a pullback in a bear channel. What do you do below 56? Let's say it's a bear bar closing on its low. I would continue to wait. That would obviously be bearish, but you'd still be selling at the bottom of a 2-day trading range. And I would wait to see if we get a breakout. As you can tell, I'm slightly more bullish than bearish. You know, we've been going up on every time frame sideways for 2 days here, and today we sold off in a bear channel, and we're getting a bull breakout above the bear channel, which is what usually happens. And we have a good breakout bar 55. So odds favor the bulls, but this is so far not likely to be a big bull trend day. It's probably going to be more like those trading range days that I showed that are much more common. Here's a FOMC report, and we did that. FOMC report, we did that. FOMC report, and we did that. Another few seconds for the bar to close. And I think the bulls did the minimum necessary to see the 57 open above the 56 close. As soon as traders saw the absence of a bear bar, a lot of traders just hit buy the market, and therefore 57 opened above 56. Still not yet strongly bullish, and the bulls who did buy that have a stop below 55, which means they're risking about 4 points, and the probability is not nearly as high as they want it to be. At the moment, I am still flat, but I'm looking to buy. For me to look to sell, for the bears, they have a double top, lower high 33. I probably will not sell below 57. If it's a 3 or 4 tick bear bar closing on its low, it'll increase the chances that the bull reversal will fail. But right now the odds slightly favor the bulls, so we are always in long. I compress the chart because the bars are too hard to read when they are too big relative to the height of the screen. Final minute of the bar. Buyers or sellers below its low? Well, it depends on what it looks like. If it has a 2 or 3 tick body closing on its low, bulls will wait to buy. Aggressive bears will sell, but a lot of bears will wait for 2 or 3 bear bars or for 1 or 2 big bear bars before selling. A terrible follow-through bar for the bulls. Aggressive bears would sell, but I still think always in long. A lot of bulls will get out below 57 or 56, and therefore the bears are trying to push it down below 57 to make the bulls give up. If the bulls give up, they will not be eager to buy. That would make it easier for the bears to break below 53. Again, this looks like this kind of an open. We got a reversal, and the bears tried to sell off, could not. Strong enough reversal. The bears needed a double top before they could push the market down, and that's probably the same here. This is probably a minor reversal. More likely buyers below, stop below 55, and the bears will need a double top. Very similar to this. The difference is today we have a better sell signal bar, but overall the pattern is the same. Sell-off, reversal, and then disappointing follow-through. And the bears needed a double top. So we have a sell-off, reversal, terrible follow-through, but the bears probably will need a double top. So slightly more likely that there'll be buyers somewhere below 57 than 57 falling all the way below 55. But with it closing on its low, a lot of the bulls do not want to buy it. They want to wait. Will 58 close on its high in the gate part of 57, or will it not? I did not do anything because 57 closed on its low. Whenever you get a strong breakout and then you get a bear bar within a bar or two closing on its low, it reduces the probability for the bulls, and I usually end up waiting. Still, probably buyers here. For the bears, 58, bad entry bar. So still, I think we're still always in long from 55, but I think the math is very difficult to structure a trade. You want reward twice your risk at a minimum, because the probability up or down is probably only 40%, maybe a little bit higher for up. But when the movement is small like this, it's hard to get a reward twice your risk. 59, a pullback from the 55 bull reversal, and we're always in long. But with all of the reversals today, recently, and then all day, a lot of traders are hesitant to buy. They would feel better about it if 55 was a bull bar and 56 was a big bull bar. But instead, all the bulls got was a doji, and then the bears got a big bear bar closing on its low. For the bulls, if they buy 57 low, 59 high, stop below 55. And for the bears, I think they need like a second entry short, maybe a double top 57, maybe 60. Bears do not want to sell on a stop below 55 at yesterday's low and at the 60-minute moving average. If they get a strong bear breakout, then sell the close. Right now, this looks like this, a reversal and confusion. Follow through for the bears, more bad follow through for the bulls, and another weak buy signal bar, especially after the 57 bear bar. And this makes it, I think, difficult to structure a trade. You can buy and put a stop below 55 and hold for a swing up. But my thought about that is this does not have a high probability for a swing. And if it starts to swing up, it'll become clear within a few bars. It would be higher probability to enter after it's clearly swinging up. Final bar of the hour, and it's an outside up bar, 60-minute chart. We have a new all-time high here. Let me get rid of this. This is getting too crowded. We have a measured move up based upon the height of that range. We have a measured move up based upon this double bottom neckline. We have a measured move up based upon the height of that sell climax, and we're right there. Five ticks above 57 low, so limit order bulls made money. One of the very difficult things in a trading range is a lot of traders they want to enter with stops, and then they see a stop entry above 54 and decide it's not very good. Then they start looking to buy closes, and the problem you have is it's still a trading range day, and if the more you wait to buy, the higher up you are in a trading range, the probability of making money goes down. And because everyone needs to be aware in a trading range. It doesn't matter if you have a reversal 55 and a bull bar 59.60, right? Trading range days usually do not become clearly bullish until they're near the high, and then they reverse down as soon as they become bullish. And they usually do not become clearly bearish until they're at the low of the day, and then they reverse up. So the bulls waiting for clarity, they get a 1-bar breakout and they buy, ignoring that it's a trading range day, and that 1-bar breakout is probably a second leg trap, forcing them or tricking them into buying at the top of a trading range day right before a reversal down. Nothing has changed, still always in long, but not strongly bullish. And while it could be the start of a bull trend, it's still in a trading range. It's in a bull trend, but it's still also in a trading range. So buying here is buying at the top of a trading range. The bulls need to do more to convince traders that it's no longer in a trading range and instead only in a bull trend. Probably buyers below 61, but why are we getting this kind of follow through after bull bars? This happens more if a rally is part of a trading range. Remember I said over here we had a double top. We had a strong reversal, a pullback, and then a double top. Strong reversal, a pullback, and a double top. This one is only a few bars wide. This one is maybe 10 bars wide, but the situation is similar, very similar. This is an FOMC report from back in November. Still always in long, but very weak rally. It looks more like a bull leg in a trading range, and that makes it difficult to trade. I think very similar to what we have here, and that makes it difficult to trade, certainly difficult to trade with stops. Here you have a high one, bull flag 59 after a strong bull reversal, and it only rallied 4 ticks, not enough for a profit. The limit order bulls had to buy below 57, a bear bar closing on its low. The limit order bears probably wanted to sell 57 high, but did not allow them to sell. I have not placed an E-mini trade so far after the report, which is extremely unusual for me. Similar to this, reversal, tried to resume up, so 2 attempts up failed in a broad bear channel, and the market traded down later in the day. So it's a similar situation. A bear channel, really a trading range, but we are getting lower highs. And, we're having a couple attempts to resume up, and both are failing so far. But the range is so small that I think it's better to just do nothing. Even the bulls who bought the 55 or 56 closes, a decent reversal, have not made money. Some days it's pretty easy to make money, and today is an example of a day when it's difficult. The range is very tight, even with the FOMC report. Bears selling because the bulls tried twice to go up and failed. So the bears are thinking, well, maybe the bulls do not want to buy up here, and they'll buy lower. So the bears are selling to explore where the bulls will start buying again. That template that I keep showing got down near the low of the day, low of the reversal, but not below. The odds at this point are against a big trend, but I'll change my mind if we break strongly below the 60-minute moving average in yesterday's low. We still have that that sell signal on the daily chart. Yesterday in the daily chart, we have a wedge 1, 2, 3. I said that we probably would break above the high one buy from a few days ago, but that we probably would only go up a few bars, a few days, and the bears would try to get the parabolic wedge top to reverse 1, 2, 3. If the bulls get a decent buy signal bar, some bulls will buy above it if it does not become too big, and I think the bears will exit shorts. There's still time for a trend up and possibly down, alternatively. However, the odds are we're going to stay quiet for the rest of the day. Traders are waiting to see will it close on its high. Then we have a double bottom at the 60-minute moving average and the low of the day. We had a double top at the high of the day. So this is a potential buy. The problem is the obvious one of the math, the probability. Who thinks that this is going to lead to a break above the 60 neckline of the double bottom and then a measured move up? Most people think the best the bulls will get is a trading range, and then you have to be thinking about scalping. 1 point, 2 points. 2 points is probably too much, and then you're scalping for 1 point. You're buying here, you're risking, what is that, about 7 or 8 ticks to make 1 point, and to make it a profitable strategy, you have to be right maybe 80% of the time. Do you think there's an 80% chance it's going to go 6 ticks above 67 before going 1 tick below? I think there's maybe a 60% chance, but I'm not convinced that there's an 80% chance. And because I'm not convinced that it's an 80% chance, it makes it a difficult stop order trade. It's really amazing. If you were to look at this, would you think, wow, this is obviously an FOMC day? Or would you look at this and say, it's just a regular trading range day? This is as small a reaction as I've ever seen after an FOMC report. Let me just check the volume on bar 55. 21,000 contracts, which is okay. You can see not a lot of bulls buying that 67 high because they did the math. They knew a swing was unlikely. That means it's a scalp. And if it's a scalp, they have to risk 8 ticks to make 4 ticks. And therefore, a lot of the bulls are not buying. It's probably better to buy right here below 68 than it is to buy above 67. For the bears, I think we're right at support. We have a double bottom with decent bull bars, 55, 67, 60-minute moving average, yesterday's low, and therefore it's a low probability sell below 68. If you're selling it, you're betting on a break below all that support. The double bottom, 60-minute moving average, yesterday's low, and that is a low probability bet, and therefore probably more buyers than sellers below 68. Most traders should just wait. There's still time for buy the close, sell the close, but it's not likely to happen. Look to the left, right? We have 69 bars in a 5-point range. So the market is satisfied with the current price level and therefore unlikely to have a trend at the end of the day. This happens all the time. The bulls have a second entry buy, and the bears hope to get a low too short. They're hoping the reversal up above 69 forms a double top 68, and then we get down to the new low of the day. The math is, I think, difficult here, and while I'm slightly more bullish than bearish because we're at the bottom of a trading range, it's hard to structure a trade. I'm just showing this to remind traders that even when the market is very quiet after the FMOC report, you can still get a surprisingly big move at the end of the day. Not likely, but if it starts to happen and you're aware that it can happen, it's easier to sell a close. So what about selling the low two? We have a double bottom, a small double bottom, 67 and 70, and a bigger double bottom here, but we're getting a low two at the bottom of a trading range, and it's an okay swing. This is a fairly common setup. Low two and a bear trend. That's not what we have. This is what we have, a low two and a trading range. Bulls trying to reverse, and we got a low two below that bear bar, and the sell-off not all that strong, but it still went down for a swing. This is a low two and a bear trend. That's not what we have. This is a low two at the bottom of a trading range, but the trading range is a bull flag, so you'd expect that low two to probably fail. So bull trend, trading range, the market's deciding between trend reversal down, trend resumption up. Strong enough reversal, more likely will go up. So even though the bears trigger low two there, you can see the bears triggered their low two at the bottom of a trading range. That trading range was a bull flag on a higher time frame chart. Right now, this is what the bears are hoping they'll get: a trading range and a low two, and then a measured move down at the end of the day. The bulls, I think we're always in long, but it would just take one or two bars to flip it to short. If 72 closes on its low and then 73 trades below, I think the bulls will exit. If it's even a one-tick bear body, I think a lot of the bulls will give up because the math is bad. Their stop is further away than they want, and at this point, they suspect that the best they get is a scalp, and exiting below 72 instead of below 67 or 55 would reduce their loss. So I think a lot of the bulls who bought will get out here, and the bears, this is not a stop water market. So if you're selling below 72, you're betting that we're going to successfully break below this low, that low, the 60-minute moving average, yesterday's low. That's a lot of support, especially when there's no momentum leading up to it all day. So just like it's not a great buy for the bulls with a stop above 69 or 70, it's not a great short for the bears below 68 or 72. Now it's a triangle, 3 reversals up, 67, 69. Obviously, one of these stop entries eventually will be successful, but I've seen the market have 10 or more reversals in a row without a single stop entry being profitable. So, I understand regression to the mean, and eventually it's got to work, but you can lose so much money before it does work that, it's a stupid way to trade. So most traders should just simply wait. Around 12:35, where we are right now, is when the market usually tries to enter a buy the close or sell the close trend. So this is it. The bears are trying to get it with 72. The bulls are trying to get it with 73. But I think it's going to be very difficult to make money between now and the close. We're at the end of the day. Yesterday is a sell signal bar on the daily chart. And then today is a bear inside bar. So that's adding a little bit of bearishness to the chart. Weekly chart, so far a small bar, and we still have a couple of days left. It could be a bear bar by the end of the week. Monthly chart, it's becoming increasingly unlikely that the month will become upside down. The low of the month is about 40 points below where we are. We still have Thursday, Friday, Monday, 3 days, so it's possible that we could still go upside down, but it's not likely. You can look at your account and say, darn, my account's not any bigger today. Well, if you did not trade, or if you only took 1 or 2 trades, then your account is also not smaller. And on a day like today, it's very easy for your account to get smaller. So some days it's just very difficult to structure a lot of trades. And today's a good example. I think I'm only taking 1 E-mini trade today, selling the 13 high, and that was it for the E-mini. Bears getting their breakout. We have that gap up yesterday, and the bottom of the gap is that lower pink line over here. Will it be sell the close? I had a couple of examples where we got a late breakout with the FOMC, but not easy to trade. This one lasted 2 or 3 bars, similar to today. What about buying here on 55 low, trading range day? I would either be short or selling and take a chance on the follow through than betting on the failed breakout and reversal up. So I think it's more likely we'll get at least a little bit more down. One problem that the bears have is 43 buy the close, 48 buy the close, 54 buy the close, 66 buy the close. So is this going to be different? And then for the bulls, 55, sell the close. 60, sell the close. And now the market's asking us to do the opposite, to bet on a trend. I'm eager to trade. Everybody's eager to trade, but very difficult to make money starting at 1250 like this. The odds are we'll get a little bit more down, but traders are watching the close of this bar. If it closes 2 or 3 or 4 ticks off its low, nobody's going to sell the close. If it closes on its low, you'll still have some traders buying the close, betting that it will be like all the other bars today. This is the comparable bar right here, even though it's not new low of the day. It's that late breakout. You can see a lot of traders bought that close, right? So not a very reliable trading day. For the bulls, a failed breakout, expanding triangle 48.54, bottom of a bull channel, failed breakout yesterday's low, but a lot of traders will do nothing here. Buy the close. Bulls 76 made money, but we're so late in the day. I tried to sell 76 with a limit order on the 1 minute chart, and I did not get filled. So I'm probably not going to take any more trades. Normally that kind of a bar would be a good scalp bar at the end of the day. You get a strong reversal with a strong signal bar like that at the end of the day. It's, has a high probability for a scalp, but how much do you have to risk? You have to risk 3 points to make 1 point, and I think that's not worth it. You can see how that bar is quickly reversing up, down, up, down, up, down. That's a sign of a lot of trading, and this is bar 78, usually the biggest bar of the day. Let's see what we got. It's not all that big, about 47,000 contracts. Obviously bigger than the other bars, but still not all that big. Daily chart, by trading below yesterday's low right here, we triggered the sell signal on the daily chart. But look what we're doing now. We're reversing much of the day's sell-off. We're about a 50% pullback right now. Daily chart, parabolic wedge, probably will start to go sideways soon. Just like this, strong rally, trading range, strong rally, trading range, strong rally, probably trading range. Monthly chart, a month may be getting a smaller body, and here, shrinking bodies, trading range, and shrinking bodies, trading range. So it looks like a pullback or a sideways, but the trend is so strong that whatever reversal we get will be a minor reversal, even if it lasts for a few months. Monthly chart, this is, how many bars is this? This is like 8 months without a pullback, extremely strong. We had, like 7 here, 6 here. So this is really unusual. You'd have to look back, several years, many years to find an 8-bar bull microchannel on the monthly chart. As strong as this was, we got 1, 2, 3, 4, 5, 6, 7, and a pullback. 3, 4, 5, 6, 7, 8, about 8 or 9, and then a pullback. So this is about the outer limits of what a strong trend can do without having a pullback. But there's no top yet. And when the trend is very strong, like over here, bulls will buy the pullback, and therefore it's more likely to be a bull flag than a reversal. And yesterday was a trading range day, and the past few days, past month, most of the days have had mostly trading range trading, so that was likely today. We opened below yesterday's high. We tested yesterday's high, and then we tested it again, bar 10, And then bar 12, I mentioned that it looked like it was probably a give up bar, and that we get a second leg down. I didn't have an opinion about having 70 bars down from there, but I thought we'd get at least a small second leg down. In other words, a small swing down, maybe a couple hours or so, and we traded down for the rest of the day. FOMC report 55. That's about as quiet a response as you can see after an FOMC report. For the bulls, well, let's take from the bear case, that tail on the bottom of one microdouble bottom moving average. While I think there probably are buyers here, I'm not confident that we're going to break above yesterday's high. Look at the bear bars here, here, and here at that price level. And we have a bear bar here, and then we have a bear bar again at 11. So I think, it looks like we'll probably go sideways. Maybe we'll go down. 10, 11, possible high of the day, but a lot of trading range price action. So I suspect sideways more likely. Got a couple small legs down here. The bulls tried to get a wedge bull flag, very weak reversal. And then we're getting very close to the FOMC meeting, and the market just became extremely quiet. Traders looking for stop entries, I think buying above 2-3 for a scalp, selling below 11 for a scalp. And then these are tough buys and tough sells. Maybe here you have a head and shoulders top bear flag, left shoulder head, right shoulder. You have a low too short, breakout pullback, looking for a second leg down. And then buying above here, I would not. Selling below 57. It turned out that it was okay. The bulls had a strong bull bar 60, but could not get above the 57 high. 61, not a good sell signal bar. And I showed that example of a similar day where we had a reversal, a second attempt up, and then a sell off. And today is pretty similar to that. Strong reversal up, second attempt up, and then a sell off at the end of the day. This is also an FOMC day, and today followed it pretty closely. Bear trend, reversal, and then a double top, and then a sell off. Buying above 77. In the days before speaking in the chat room, I usually would take that buy for a scalp, but it's just really hard for me to take the trade, manage the trade, think about the trade, and think about what I'm going to say. So, now that I'm in the room, I usually do not take that kind of a trade, although I sometimes do. Sometimes it's so obvious and easy that I just take it and not worry about it. For buy the close, sell the close, sell the close, maybe bar 12, looking for a little bit more down, but the range is so tight. Yesterday's so tight. FOMC coming up, probably going sideways, not really good. And then for the rest of the day, it's a very tight trading range day, so it's one of those opposite days. Every time there's a big bear bar, you buy the close. Every time there's a big bull bar, you sell the close. So, where would it start? Maybe over here. Buy, sell, buy. This one I guess I get profitable right there, and then buy, and then sell. But this one, obviously, it's too late to take. The more the day has big swings, the better it is to buy strong bull closes, sell strong bear closes. The more it's in a tight trading range, the better it is to do the opposite. One of the difficulties with a day where there's an FOMC announcement is that it's like two different days. The day starts over at 11 o'clock, and therefore 10 o'clock is pretty much the final hour. Sometimes 9 o'clock it starts to behave like the final hour, and that makes a lot of traders hesitant to trade with limit orders too close into the report. So it removes a big chunk of bars from limit order trading. Limit orders today, I said traders probably sold the one close for test of the moving average and then bought the one low. Not a strong reversal, so they probably sold above, and they probably would sell the high of the day and the high of yesterday as well. They did not get a chance. The 13 high, I thought 12 was a give-up bar. I thought it looked like We were probably going to try testing yesterday's low after twice trying to get above yesterday's high. Maybe we try the other way. And so I thought sellers above 12. And I thought we were, probably always in short with the 12 close, the 17 close, but really tight range. And, when it's that tight, it's very hard to make money even with limit orders. Selling the 16 high, you did not make money for like 15 or 20 bars. Buying the 22 low did not take as long, but it took a long time. Then buying prior lows, buying the 18 low, then buying the 48 low, buying the 55 low is a really tough one because then you're buying a breakup low, yesterday's low, and yesterday is a sell signal bar on the daily chart. Well, on every day, my number one goal is to do the right thing, and then number two goal, try to avoid stupid things. I don't want to lose money. And then number three goal, make money. And today's one of those pizza money days. Did not make a lot of money today. Where do we go from here? Well, we are in an incredibly strong bull trend on the daily, weekly, and monthly charts, and it's really climactic. And I'm sitting on cash that I want to use to buy stock, and I want to hold the stock for a year or two or three, and I'm not buying Boeing airline up here, and I am not buying Facebook up here. So I'm stuck, waiting for a pullback, and I probably would need one lasting several months before I was willing to buy. Question about the dollar versus the yen, 240-minute chart. All right, so 4-hour chart, bear trend, stair stepping down, getting stronger reversals, a minor reversal, but strong enough to break above the bear channel. And now we have a series of gap bars, gaps between the lows and the moving average, sign of strong bulls. And therefore, this is probably going to either form a trading range or the bulls will get a major trend reversal. And the major trend reversal could be a higher low, a double bottom, or a lower low. Right now, I think it's more likely going to be a higher low. So better than 50-50, the bulls will get a higher low and an attempt at a major trend reversal. Will they be successful? It's too early to tell. Okay, we're at a support level, spike pullback channel, a sell-off down to the bottom of the channel. Now we have a spike pullback channel, and the target for the bulls is the top of the channel, which is also around a 50% pullback. Very strong reversal down here, double top neckline, measured move down here, but big enough breakout above the bull, the bear channel and the moving average to make me think the odds are the bulls will try to get a major trend reversal. In other words, they'll try to form a higher low. If not a higher low, then a double bottom. If not a double bottom, then a lower low. But strong enough reversal so that bulls are probably beginning to buy here, 50% pullback, expecting either a trading range or a successful trend reversal. So right now, I think better than 50-50 chance the bulls will hold above this low and try to get a second leg up. Five-minute chart, dollar got crushed, just like it did against the euro. All right, this is the euro versus the dollar. This is the futures contract, but the dollar got crushed. Other than the E-mini, what did you trade today? Well, I traded stocks. In particular, I traded Boeing, which had that huge breakout and then a pullback to double bottom or triangle, expecting at least a little bit more up. But other than that, I have some option positions on. And other than that, I just waited. Question, the other day you mentioned something about bar 24 being a common reversal bar. Yeah, if the day is going to be a trading range day, it's pretty common that the market tries to reverse around bar 24, the end of the second hour. If not around 24, then bar 36, the end of the third hour. So if I think the day has a lot of trading range price action, I start to look for reversals around bar 24 and around bar 36. Yesterday, bar 32. Today is not really anything like that. But here, bar 24 exactly to the tick, or to the exact bar, with spike pullback channel with 4 pushes down and a good buy signal bar. So chances are we're going to have a swing up. Trading range day, you swing down for 2 or 3 hours. You expect to swing up for 2 or 3 hours. Buying above 24, chances are we'll get a couple of hours of sideways to up. And it turns out the bulls got 4 hours up from there. That's just one of those tricks. You can see a lot of trading range days, a lot of trading range price action. So you're looking for reversals and you're looking for different things, patterns, but time is also important. The market often tries to reverse at bar 24 or bar 36. So I'm looking for it. All right. We still have 3 trading days left of the month. While I think it's very unlikely that we're going to go upside down on the month, if this is the start of a surprise correction from the extreme buy climaxes on, this is the monthly chart, you'll get surprises like a huge upside down bar on the monthly chart with just 3 days left. What's the chance of that? I would say 10 or 20%. And 5-minute chart still looks like a bear leg in a trading range, but it could become an endless pullback. And I bring up the endless pullback because of this. Okay. Very tight channel with 3 pushes up, therefore a parabolic wedge. Parabolic wedges usually do not have strong bear breakouts. Usually a parabolic wedge has an endless pullback. Like this. It starts to pull back for 5 bars, 10 bars. Here, like this, parabolic wedge, a little pullback. Okay, just not all that bearish. Pullback, bull flag, right? By pullback, by definition, you're expecting the trend to resume. But after it's pulled back for 10, 20, or 30 bars, you start thinking, oh, maybe it's not a pullback. Maybe it's an endless pullback and the start of a bear trend. And then you get this. So, and this took 20 or 30 bars to do. If the daily chart pulls back for 20 or 30 bars in a tight trading range, traders are going to start saying, well, maybe it's not a pullback and a bull flag. Maybe it's an early bear trend. And that's always the thing traders watch for after a parabolic wedge top. We have a parabolic wedge top. Odds are we're not going to reverse down strongly. Odds are if we pull back, we'll pull back, 4 or 5 days, and then traders start to wonder if it's going to be an endless pullback and lead to a bear breakout, or will it be a bull flag and lead to trend resumption up. I think this is what the next couple of weeks will look like. kind of drifting sideways to down as traders decide what to do with the parabolic wedge. Parabolic wedge, pullback. For a lot of bars, the bears got their breakout, but the bulls got a reversal up. This is the bull case. Parabolic wedge, sideways to down for 10 bars, 20 bars. Usually it's a pullback, which means it's probably going to get an upside breakout. But sometimes it's a start of a bear trend and you get a downside breakout. So in general, 40% chance it's a reversal, and 60% chance it's a bull flag, and we'll go at least a little bit higher. All right, my voice is running out, and that's it for questions. But we're at a really interesting time here. I find everything interesting, but I think, the daily, it's very unusual to have the daily, weekly, and monthly charts not only be overbought, but to be extremely overbought. And that increases the chances that we'll add a significant reversal. Monthly chart, like I said, this is 8 months without a pullback. For 8 months, anytime the market got near the low of the prior month, bulls bought, and they prevented it from getting below the prior month's low. We have a buy climax, a high one, and a measured move target. Usually the market goes up 1, 2, or 3 months and then pulls back. This is the 3rd month after the high one buy. So that means we should be pulling back either in the remaining 3 days of the month or next month. The bulls are hoping that we'll get this, but I think more likely this is going to be a bull leg in a trading range and will come down here. And I think within the next few years, this will be a final bull flag and we'll get down to 1800, but it might take a few years to get there. Okay, hope everybody has a good night.